Stocks advanced for the third quarter out of the last four, pushing the S&P 500 to a new record close on May 21st. While the Federal Reserve threatened to let the air out of the rally as the quarter wound down, key indicators largely showed improvement, even as the effects of the sequester cuts presumably trickled down to Main Street. The dollar strengthened and gold was hit hard, though oil pushed towards $100 a barrel. All of this happened as the housing recovery continued undeterred. When Federal Reserve Chairman Ben Bernanke mentioned on June 19th that the central bank might reduce its easing effort later this year and end quantitative easing 3 altogether in mid-2014, global markets tumbled and the S&P 500 ended up having its first losing month in several. While this was the major event affecting investors in the second quarter, there were many other consequential economic developments. The jobless rate was at 7.6% by May, with the long-term unemployed numbering 4.3 million. That's 1 million less than a year before. Consumer spending staged a rebound, while consumer incomes rose in May, its biggest gain in 3 months. As for consumer inflation, it was certainly mild. The Consumer Price Index rose in May to bring America's annualized inflation rate to 1.4%. The yield on benchmark 10-year T-notes rose in June. That is the second consecutive month where the yield moved up significantly. As bond yields move higher, bond prices will typically fall, adding significant pressure to a bond portfolio's holdings. China's economy showed distinct signs of cooling off in this quarter. Its manufacturing sector contracted in May and June, and fears emerged that China might fall short of its gross domestic product target this year. In an effort to clamp down on shadow banking, the People's Bank of China attempted to curb the funding in the interbank lending market, resulting in skyrocketing short-term interest rates. Chinese stocks fell sharply in the wake of that move. The good news from Europe is that by June, Eurozone inflation had declined almost 1% a year. The bad news, it's on the rise since April, and unemployment for the Euro area rose in May as well. With hints of waning demand in China, U.S. stocks hitting all new time highs, and the dollar growing stronger, there was plenty of selling. The quarter was a disaster for gold, silver, and platinum, which all saw double-digit declines. For some other commodities, it was a different story. The first half of 2013 ended with oil, natural gas, and cotton all up. The U.S. dollar index rose as well in the quarter. A steady stream of positive news arrived from the real estate sector. Home prices across 20 cities rose significantly in 12 months, a yearly gain not seen that large since March 2006. By May, the National Association of Realtors reported double-digit annual gains in existing home sales and the median price of a residential resale. On the other hand, this might have been the last quarter for rock-bottom mortgage rates. The average interest rate for the 30-year mortgage had risen to 4.46%, up from 3.57% on March 28th. The second quarter of 2013 was not as spectacular for U.S. equities as its predecessor. Still, all 3 major U.S. stock indices advanced. Investor fear increased, however, at least as measured by the Chicago Board Options Exchange Volatility Index. The VIX soared in the quarter. Gloom invaded Wall Street late in the quarter when Ben Bernanke spoke of tapering quantitative easing 3. Intellectually, investors knew the Fed couldn't ease forever, but the market sure had a hard time swallowing the pill. The market dip was far from a correction, though, and subsequent economic indicators lightened the mood on the street. The coming quarter presents the market with strong challenges. Few analysts see great things ahead for this next earnings season, but there is fear that the jump in mortgage rates may slow the housing comeback, and investments are keeping wary eyes on economic and political developments in China, Europe, and the Middle East. If the housing, hiring, and personal spending numbers measure up to expectations in the coming months, stocks may move a little higher in the third quarter while Wall Street waits for fall. As always, we appreciate the trust you've placed in your LifePlan Wealth Management team. If you should have any questions, please contact a relationship manager. Have a great summer, everyone.